But the fact that gold is holding up so tremendously well after such a big run and with so many different headwinds like the US dollar yields, obviously, I think this is a clear sign of strength. So the GLD flows were actually down slightly last year. You would expect massive inflows into the ETFs in a year like 2024. So that makes me very, very confident. We've been spot on with our model and our forecast last year. We predicted 2,660 US dollars. And for this year, 2025, our model says almost 3,000 US dollars.
The gold market in 2024 has demonstrated unprecedented resilience, experiencing a remarkable 27% surge, its most substantial annual performance since 2010. A complex interplay of monetary policy, geopolitical dynamics, and fundamental currency valuations drives this extraordinary trajectory. Austrian economist Ronald-Peter Stoeferle's analysis reveals a nuanced perspective on gold's current market position. His predictive model forecasts gold reaching nearly $3,000 in 2025. Contingent upon the Federal Reserve implementing anticipated rate cuts of approximately 125 basis points by year-end. Critically, Western financial investors have not yet fully engaged with this rally. While gold ETF flows have declined, the metal has achieved a record high of $2,830.70. This performance transcends simple price appreciation, representing a profound statement about global monetary systems. The metal's impressive valuation, rising 27% in US dollars, 37% in Australian dollars, and 40% in Japanese yen, fundamentally reflects the accelerating depreciation of fiat currencies. This trend underscores gold's role as a critical hedge against monetary devaluation and economic uncertainty. Geopolitical tensions, including recent developments like China's counter-tariffs on US imports, have done little to destabilize gold's momentum. Central bank purchasing patterns and ongoing monetary policy shifts support the metal's strategic value. Stoeferle characterizes the current market as midway through its bull cycle, with substantial capital on the sidelines. The combination of limited Western investor participation and robust underlying economic fundamentals suggests significant potential for continued gold price appreciation. This analysis positions gold as an investment asset and a crucial economic indicator, reflecting broader global financial shifts, including inflation, changes in fiat currency values, and central bank policies. Before we dive deeper into this video, please take a moment to subscribe to our channel, hit the bell icon to ensure you never miss any updates, and share this video with your friends, family, or anyone who might find this information helpful.
I think few people know that Dubai is responsible for 25% of global gold trade now. They're the second largest gold market in the world. And I think this positive vibe that I'm seeing here definitely confirms that. And I think that people here are definitely thinking more long-term. They don't regard gold as a trade. They regard it as money, as sound money. There's a very high cultural affinity for gold. And this is pretty similar to India, to Turkey, to China, obviously, where people, they don't get nervous when the price of gold is down 1.5% per day. I think it's really a different view on gold. And the numbers are almost 2/3 of physical demand are nowadays coming from emerging markets. And I think that's also one of the reasons why the gold price is holding up so spectacularly well, because the majority of the demand is now coming from countries where they really want to have the physical stuff, and not paper contracts. And I think, this slow shift has clearly picked up momentum. And it's not only central banks from emerging markets buying gold in enormous size, but also private individuals, for investment demand, but also for jewelry. I'm so impressed about this resilience of the gold price. We shouldn't forget the US dollar, the Dixie index, is up since October, basically 10%. Now this is for stocks, for mining stocks, that's not something special, but for the US dollar, actually, a 10% move in such a short time frame, that's spectacular. Then we're seeing that 10-year yields approaching 5%. And we're actually seeing the fact that while our market participants have expected 4 to 5 rate cuts for 2025, now the majority is seeing like 1 or 2 rate cuts. So this would, let's say in the old playbook, this would be like a horror scenario for the price of gold. But still the price of gold is holding up so well. And let's not forget, gold was up 27% in US dollar terms last year. It was up 37% in Australian dollars, and I think also Canadian dollars. It was up 40% in Japanese yen terms. We could also, of course, say, it's not the price of gold rising, but rather the purchasing power of those fiat currencies collapsing by 1/3 in just 1 year. I mean, that's pretty staggering. But the fact that gold is holding up so tremendously well after such a big run and with so many different headwinds like the US dollar yields, obviously, I think this is a clear sign of strength. So this bull market is, I wouldn't say it's like the beginning. I think we're just halfway through. It's kind of a little halftime break. And I would have expected, to be honest, I'm on record saying that I'm, for the short term, a little bit of a bearish bull. I thought, okay, we would need more time to digest this spectacular move, this breakout from this pattern. But it seems that there's so much capital waiting on the sidelines. And let's not forget, Western financial investors haven't participated in that rally yet. So the GLD flows were actually down slightly last year. You would expect massive inflows into the ETFs in a year like 2024. So that makes me very, very confident. We've been spot on with our model and our forecast last year. We predicted $2,660, and for this year, 2025, our model says almost $3,000.
Ronald-Peter Stoeferle's analysis reveals a nuanced perspective on gold's performance during recent presidential administrations, highlighting the complex interplay between political leadership and economic fundamentals. During Donald Trump's presidency, gold experienced a significant 60% rise, nearly 30% before COVID-19, and an additional 30% during the pandemic. Under President Biden, gold initially remained relatively flat, but has gained more than 30%, primarily propelled by central bank purchasing and global economic conditions. Stoeferle emphasizes a critical transformation in gold's market behavior since 2020. Unlike traditional long-term bonds, gold has decoupled from conventional financial instruments, with the 20-year bond falling 44% while gold rose 72%. This divergence underscores gold's evolving role as a strategic economic asset. The COVID-19 pandemic dramatically illustrated gold's resilience. Between January 2020 and the summer of the same year, gold prices surged 27%, rising from $1,575 to over $2,000, reflecting increased economic uncertainty and investor demand for stable assets. While election periods traditionally create uncertainty for gold markets, the metal's performance under recent administration provides insights into its potential future trajectory. Stoeferle suggests that gold's value is increasingly determined by macro factors rather than direct political influence. Let's get back to the video.
I think that, to be honest, it is like when it comes to gold and Donald Trump, his first term was very, very positive for gold. And I would say this is just one driver for the price of gold. So I would say that the big picture view for gold is actually that it's not acting like a long-term bond anymore. Yeah. There has been a complete decoupling. If you have a look at charts and follow, the development of for example, the 20-year bond at constant maturity, since 2020, this long bond is down 44%, while the price of gold is up 72%. So I think that the measured in bond terms and fixed income is still by far the biggest asset class, much bigger than equities. You can tell that gold is actually in a super bull market at the moment. And I think this is really where the future demand will come from. This will be investors that will realize, well, actually, with my traditional 60-40 portfolio, this will probably not work out in an environment of higher inflation volatility. And I think that even though many people think that inflation is dead, I think the next inflation wave is actually just building up. So therefore, will there be negative news for gold from Donald Trump? Perhaps, but I think there's no way that he will really change those very, very bullish long-term dynamics that the gold price has at the moment. And I think, what people don't or most people kind of get wrong is the fact that, gold doesn't make you rich overnight. It doesn't make you poor overnight, obviously, but it's really there to protect your purchasing power over long time frames. Now, what we do, for example, is we've got the gold beer ratio, which shows you the purchasing power 1 ounce of gold at the Munich Oktoberfest. We did the same with ski tickets, as Austrians tend to be really not good at skiing anymore, but it's our favorite national sport. So people are complaining, that the ski tickets get more and more expensive. Measured in gold, actually, it's getting cheaper and cheaper. And we did the same with iPhones. And this was a chart or an infograph that was extremely popular with the younger generation because they realized, well, actually, in gold terms, the prices of an iPhone are not going up every year, they're rather going down. So what we really try to do is educate the younger generation because, as I've said, you tend to become a little bit more conservative. But if you reach them when they're young, I had my first contact with gold getting like little gold ounces from my grandparents, for Christmas and for birthdays. So I think it's important, even though they might be more interested in Bitcoin, crypto, whatever, to just introduce them to the virtues of gold. Well, I think that, if you are a generalist investor and you think that, well, actually gold is doing well, I want to have some more leverage on the price of gold. Let's have a look at mining stocks. What do those generalist investors usually buy? They buy the largest stocks. If you have a look at the charts of Newmont, Barrick, well, actually last year, I think they were flat or even slightly down.
Gold has shown impressive strength and growth in recent years, propelled by macroeconomic factors, policy decisions, and global uncertainties. Despite market volatility and shifting economic conditions, its consistent rise underscores its value as a stable asset. With ongoing concerns over inflation, central bank purchases, and broader economic dynamics, gold continues to demonstrate its resilience. As these trends persist, gold's role as a crucial asset in preserving wealth and reflecting broader financial transformations remains strong. Will gold continue its upward momentum in the coming years? Let us know your thoughts in the comments below. If you found this video insightful, don't forget to like and subscribe for more updates on gold and the global economy. Thanks for watching.